This is going to be a longer introduction, but it's going to set the tone for the video. If you don't want to hear me ramble for 2 minutes, then fast forward to where the video actually gets into the setups. But I just want to outline here because I'm curious. Have you ever wondered what is the number one setup? Like, what's the perfect setup? The perfect entry from continuation basis, the cup and handles, the volatility contraction patterns, the flags, the pennants, the wedges, the Darvis boxes. Have you ever wondered, like, what does that perfect setup look like? Then I wonder, have you spent thousands and thousands and thousands of hours studying it, and studying it deliberately from 4 main elements, studying it from a identification standpoint? Can you identify this setup time and time and time again? Is it repeatable? Is it timeless? Can you look at a chart from 100 years ago and see the same setup from 50 years ago, from 20 years ago, from 2 years ago, from 2 weeks ago, from 2 days ago? Is the same thing happening? Can you see it across all time frames? Then how do you go about controlling the risk? How do you create asymmetric risk versus reward trading opportunities, i.e. risk a little to try and make a lot? How do you then mitigate the risk? How do you position yourself beyond the possibility of defeat? Take all the risk out, free roll the trade, and still have a free look on par or the majority of your position. How do you go about doing that on a repeatable basis? Then finally, how do you optimize the profits? What are the sell rules to keep you in the intermediate term trend? What are guidelines that you can use to try and stay in the trend? And that's what I'm going to try and do in this video. Now, I have not created anything. These are just my own observations. There are trading legends who have come before me, and I'm not saying I'm a trading legend. I have studied them relentlessly, obsessively, and none more so than Jesse Livermore has had a bigger impact on my trading. And this video is really going to center around his key concepts of understanding the line of least resistance and continuation pivotal points. And this quote here from Livermore sums it up perfectly, what this video, the real essence of this video, is going to be about. I absolutely believe that price movement patterns are being repeated. They are recurring patterns that appear over and over with slight variations. The stock market must be studied, not in a casual way, but in a deep, knowledgeable way. And that's what this video is going to do. It's about 240 slides that I've got for you. It's going to be an absolute monster, but I'm going to take you through what I think is the number one setup, the perfect setup, and in chronological order, I'm going to take you through the same setup from the 1970s to present day and cover it from the 4 main elements of identify it, control it, mitigate it, and optimize it. Like, I think this video is going to be pretty darn good, and I'm just at the introduction of it. Like, I think it's going to be really good. So I'd appreciate if you enjoy the video, please do like it, leave me a comment down below because you're probably going to have questions on it. So I'm very happy to answer your questions in the comment section below. Before we get into it, let you know that MarketSmith are the video sponsor. There's a discounted trial available in the comment section below. Now, with all of that out of the way, let's start getting into it. So let me just give you an overview of the just multiple charts that you're going to be seeing. Let me give you an overview for what you are basically looking for. We're going to be looking at stocks that are in powerful uptrends, and on each slide as we progress, I'm going to go deeper and deeper and deeper and try and give you little bits of information per slide as we go. I can't give it to you all in one slide. Like, I just can't, right? I simply just can't, actually. So I'm just going to give you like bits of information as we go, as we look at examples, and I'm hoping the deliberate nature, the repetition of it may or may not help you. If it helps you, great. If it doesn't help you, click on a different video pretty darn quickly, I would say. So let's get into it. So the recurring patterns. It's basically going to be themes of flags, pennants, wedges, VCPs, Darvis boxes, whatever you want to call it. But in essence, what we are looking for is a stock in a powerful uptrend and then starts consolidating, basically meaning it starts going sideways. And there's going to be 2 key moving averages to be paying attention to. Is going to be the 10-day EMA and also the 21-day EMA. So on this visual example here, I'm just showing you the left side and the right side because this is what the next like 240 slides are going to look like in terms of price and volume action. So we're basically looking for stocks that have a powerful move up and then start respecting their 10-day EMA and or their 10-day and 21-day EMA, and then set up when price action gets really tight. This is going to be a key concept. Tightness in price and trigger bars. Like, so the trigger bar for me, I'm going to link this into continuation pivotal points, the line of least resistance, and when the stock is telling me I'm ready to go. Like, now is the time, I'm ready to go higher. And then how do you get in, how do you identify it first and foremost? How do we then create an asymmetric risk versus reward trade? Where do we place the initial stop loss? How do we then mitigate the risk on the trade? And then how do we sit and try and ride the intermediate term trend? So it's going to be variations of this, okay? Powerful uptrend, respect the 10, respect the 10, respect the 10, respect the 10. If it doesn't respect the 10, then we're looking for the 21-day EMA to be respected, like in here, like in here, like in here, like in here. It then may coincide as a confluence that it then starts respecting before it breaks out the 10 and the 21. So another great quote from Livermore: I traded to beat the game, and a big part was having the right timing. My quest was never ending to refine and develop the pivotal point approach, my approach to trading new highs, finding the industry leaders and the best industry group. Like Livermore, he just had such an impact on my trading. I wish I got to meet him, but I never will. But I just read his books, read everything I can about him just religiously. The guy had a huge impact on my trading. So let's just do a quick overview. So the identify part, what are we actually looking to do? So low risk, tight price areas where volume has dried up in the context of stocks basing and or in powerful uptrends resting on their 10-day and or 21-day moving averages. So they're exponential moving averages. Control, how do we go about creating asymmetric risk to reward trades? Risk a little to make a lot. Mitigate, how to free roll positions to be risk free. Optimize, sell rules for riding intermediate term trends using key moving averages. So I am an intermediate term trend follower. If you're a scalper, this video is probably not for you. There are 4 parts, I think, with any trading strategy that you can control. You can control when you buy, how much you buy, when you sell, how much you sell. Pretty darn simple. So that is what everything is basically going to center around in terms of identify, control, mitigate, and optimize. It centers around what you can control as prices doing this. How do you react to that? How do you make high quality decisions? So let's start going through. I don't want to be reading to you. I don't think it's an English lesson, but here are some of my belief systems that I believe with trading and what tries to go into my trading strategy. Here's another slide as well with some really good quotes from Livermore that I just wholeheartedly believe. Like, these are my belief systems. But here we go. You probably want to see some slides, don't you? So don't worry. There's no now text heavy slides for the next 235 slides. Like, it is charts, and more charts with me explaining as we go. So do not try and get it all on chart number 1. You ain't going to get it all on chart number 1. Like, it's not going to make sense. There are so many nuances to be going into here. So I'm going to pick apart a couple. And what I would suggest is when you've watched this video, watch it back a second time, because as you start going through the examples now, you can see we're back in the 1970s. As you start going through these examples, and then you have the knowledge of everything else you're about to learn in this video, when you then start looking at these examples, you now have new knowledge you didn't have at this moment in time when you watch it back a second time. Hopefully that makes sense. So let's just start broad, right? I'm zooming out. We're not going to get really into the details in terms of what does this candlestick mean with this volume? What does that mean? What are these blue dots down here on the relative strength line? What does all that mean? In essence, you're basically looking for a stock that is going up like a little bit of a staircase, right? So here you go. See how the stock rallies and then it pulls in, and what's going to be really important for you to focus on in this video is the black line, which is the 10-day EMA, and the blue line, which is the 21-day EMA. Black line and blue line are going to be the most important. Third to those is the purple line, which is the 50-day simple moving average, the SMA. And then the grey line is the 100 SMA, and the red line is the 200 SMA. But for the purpose of this video, is black line and blue line, black line and blue line, black line and blue line. Really focus on those and note the trend of the other moving averages. They're going to be like this, and quite commonly, you're going to see 52-week highs on this relative strength line. Search my name on TradingView, you'll find it. It's a free indicator. What you're going to see for 99% of these kind of stocks going from 1975 to present day is you're going to see a strong healthy RS line and 52-week highs on this chart. Okay, that means it's a leader. It is a leading stock if it's hitting 52-week highs. So let's just broad brush. I've already gone too much into the weeds on this first slide. Let's zoom out a little bit, okay? This stair-step action. So the stock is basically going up, and then when it pulls in and starts consolidating, look for respect of the black line, the 10-day EMA, or the blue line, the 21-day EMA. Look for respect and for the stock to start tightening around that with these really tight candlesticks. Now, these really tight candlesticks are going to become more apparent as we go further on. These are called trigger bars, and these really help me create asymmetric risk versus reward trades when I'm trying to risk a minimum amount to try and make a shed ton. So risking tiny amounts to try and make a shed ton. That's how I think about trading. So you can see in here, we build, see how it just goes sideways, consolidates. Where does the stock find support? You're going to learn about shakeout demand tails. So it's got this shakeout demand tail, this tail that goes down, then it recovers and it finds support around this black line. Really tight here, it bounces, finds support around this black line, then bounces off this blue line, then this really tight bar, then this nice uptrend. Don't worry, we've got lots and lots of examples to go through. Don't worry, you're not going to get it all on the first slide. Here, powerful uptrend, good volume coming through, good relationship with the price. You're going to learn all about that. We're just going broad here in terms of the pattern recognition, dialing it in. What is the pattern recognition? Then see how the stock just pulls in here, and where is it finding support? It's finding support on this black line, the 10 EMA, the 10-day EMA, and then look at the tightness of the bars. Look how the volume dries up as well. These are trigger bars, so we're going to make sense, and then look at the trend thereafter. We're going to talk about all of that later on. I just want to get your pattern recognition there. So see how the stock goes sideways here. This is kind of chopping around. It's not finding support on the black or the blue line. It's kind of chopping around underneath it. That's not great. But here, powerful uptrend, pulls in, finds supportive action on the blue line, then this really tight bar, then it comes out. Really tight bars, low volumes, finding supportive action around the black or blue line. They're the key points at the minute. Think stairs, think stairs, think stairs. Footlocker here starts coming out of a big base, powerful uptrend, pulls in, see the consolidation, pulls into the 10-day, tight bar, low volume, 52-week highs. That's really good. EBF, really nice. So 1979, you'll see it up to the present day. It's the same thing. It's basically this. So the stock, leading stocks will do this. This is how they act. Powerful move up, go sideways, look at the respect for the 10, for the 10, for the 10. Look at the tightness in price coming through. Then it moves up. See how it pulls into the black line. Look at the respect for the 10, for the 10, for the 10. Really tight bar coming through in here. Then it powers up, pulls back down. This time, does not find respect for the 10-day, finds respect for the 21-day in here. Then you get this really tight bar. That's important to note here. Is every single one of these going to lead to an absolute massive gain? Absolutely not. But this is where the risk management element comes in. Risk management, money management, whatever you want to call it, and the free rolling tactics as well, which I'm going to teach you in a couple of slides time. So what I've then done is periodically, every time I show you in the beginning, every time I showed you 5 slides, I'm going to give you like a real teaching point, and we're going to do this around about 4 times or so. So when you see that really tight bar on the daily chart, I'm going to tell you about some of the optimal intraday action to see on that said trigger bar. So the trigger bar on the daily chart is where it is setting up, preferably on the black line being the 10 EMA and or the blue line being the 21-day EMA, and it's a really tight bar on low relative volume. This will all become apparent when we go forward a couple of slides. I then like to use what I call multiple time frame analysis. So as the name implies, that's using multiple time frames and conducting analysis. So I like using the 1 hour chart. So when I see a potential trigger bar forming on the higher time frame, being the daily chart, I will then drop it down onto the 1 hour chart. Now what I am looking at, and I'm going to teach you all about how I go about where's the entry, where's the initial stop, how I'm looking to free roll it. Again, we're starting up here and we're going to go deeper and deeper and deeper, but we have to start high. We then have to work our way down. Otherwise, I literally can't explain it all in one slide. There's so much to get here. So with this here, the multiple time frame analysis, when I drop it onto the 1 hour chart, there's certain repeatable characteristics that tend to show up in the best of the best setups. And this is what this is all about. The best of the best setups, not the mediocre, not the average setups, the creme de la creme, the best of the best. What do the best of the best do? I want to know. I want to know very deeply, like on a really deep level. What is it that I'm looking for? What is the pattern recognition that I have to learn? So here, see this here, the black, the blue, and the purple line, which is on the 1 hour chart, it's the same. Black line is the 10 EMA, the blue line is the 21 EMA, and the purple line is the 50 SMA. It's just on the 1 hour chart. Do you see the tightness that comes through? Do you see how tight these moving averages are together? They're really, really tight. You can hardly fit a paperclip between them. So what you have in the session on the daily chart, when you break it down onto the 1 hour chart, you're going to have 7 candlesticks. So here is one. It's represented by these vertical lines. These vertical lines are a session, which I pointed to with the arrow. So you have 1 bar, 2 bar, 3 bar, 4 bar, 5 bar, 6 bar, 7 bar. Now, you'd like to see price tightening basically in a rectangle, also known as a Davis box, basically a rectangle in price. So remember, on the higher time frame, the daily, it's a trigger bar, which is a really, really tight bar on a relative basis. Don't worry, it'll all make sense by the end. And then when I go down to the 1 hour chart and I look at that trigger bar, this is what I want to see. Basically, really tight price action, trading in pretty much a rectangle. And then the black line on the volume down here, this is the 30 bar average. This is whether you see monthly charts, weekly charts, daily charts, 1 hour charts, 1 minute chart. I just keep it set as the 30 bar average. It doesn't matter if you want to use 20 bar, 30 bar, 40 bar, 33, it doesn't matter. You're just looking at things on a relative basis, applying some common sense. So low relative volume and tightness in price. Here is a key to take away from this, which links into trigger bars. Low volume and tightness in price equals limited supply, little supply coming to the market. That's the first takeaway from this, okay? So tight bars, see, tight bar, tight bar, tight bar, tight bar, tight bar, tight bar. And what do you notice about the volume? It's low volume, low volume, low volume, so on and so forth. So tightness and price and low relative volume means there is little supply coming to the market. You want little supply coming to the market, or I certainly do, before I buy a breakout. So I'm looking for a confluence. I'm looking for the tightness and low volume on the higher time frame, and then on the 1 hour chart, I'm looking for tightness and low volume as well, with this basically this rectangle forming, and price being pretty darn close to the 10, 21 and 50 SMA on the 1 hour chart, and on the daily chart being close to the 10 EMA and or the 21 EMA, and it's been basing constructively. Let's do a couple more. So this is another one here. So see here, you have a gap. You're going to learn about gap down reverse bars. This here is a gap down reverse bar. We're on the 1 hour chart again here. I'm just showing you optimal trigger bar characteristics to see. This is a gap down reversal bar. The prior closes here, price gaps down, opens on the low of that bar, pushes up, next bar, shakeout demand tail. So what is a shakeout demand tail? Is where price goes down, shakes out weak hands by undercutting prior lows, and then the volume will tell you how much supply is coming to the market. So think about this logically. If you have a shakeout demand tail that's undercutting prior lows on a higher time frame, say like the daily chart, maybe it undercuts the 21 EMA, which undercuts the last 20 days of price action. If you get a shakeout demand tail and the volume in this instance here is half the 30 bar average, what does that tell you about supply? What does that tell you about how many stop losses were there? What does that tell you about how many weak hands were there? There weren't that many there, were they? Is that a positive sign if you're thinking about this as a developing pivotal point? Like, think about that. So what is going on in terms of the relationship of price in terms of volume as well? So shakeout demand tails, low volume is a constructive sign if it's a stock basing, and or when you're dialing in and you're looking at a trigger bar and you're looking on the 1 hour chart using the multiple time frame analysis, then it's tight, 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 and look how the volume dries up. And the 1021 black, blue, and the purple line right there like that. Got 3 more, I think, or a couple more. This is ONON. This bar here, powerful bar, opens on the low, pushes up, and then look, tight, 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 and look how the volume dries up. That's trigger bar type action. 80, 80. So here you have tightness and price. So these 4 bars that you see here, tightness and price, and look at the volume. It's around about the 30 bar average or just above. So this is indicating more so absorption of supply. So here's another key point. You see these first 4 bars here. These first 4 bars here don't look dissimilar to these last 4 bars before this breakout bar, do they? But what's the main difference? Well, the main difference is in the volume. Look at the volume here of these last 4 bars before the breakout. Look at the volume here relative to the volume here. The volume over here on the first 4 is greater. The last 2 are actually above the 30 bar average. This is indicating that there is absorption of supply. So it's all about thinking there is, the way I see it, this is a Richard Wyckoff concept as well in terms of the composite operator. Thinking about the stock is being manipulated to the advantage of a single entity. There is a single entity out there controlling this stock, and they are manipulating it to their advantage. What are they trying to do? Are they accumulating? Are they distributing? So there is not some single entity out there manipulating the stock. But for me, in terms of a belief system and a way of processing things in a framework, I find it really useful. So when I'm then looking at this and I'm thinking, okay, all of this action is being conducted by some entity, some massive institution, some large, or whatever you want to call them, a composite operator from a Wyckoff methodology standpoint. If they are manipulating the stock, if they're trying to position the stock to their advantage, what are they doing? Because there'll be repeatable characteristics of accumulation and distribution. And I'm trying to follow the footprints. What is going on? Bit of a detective, right? So in here, tight bars and then the high relative volume. Potentially this is absorption of supply. I still need to see the stock get in position. Then I see this bar here. There's a lot of buying, quite clearly, right? Bar opens on the low, closes strong, good volume. Then look at the tightness come through, but then it's really this bar here. This is a gap down reversal bar. So intention of a gap down reverse bar is to shake out weak hands, like shake out demand tails. Don't worry, you're going to learn all about this as we go. So the prior closes up here at around about $18.10. Then it gaps down, opens on the low, and then there is immediate presence of buying. There's immediate demand stepping up. Why? Because it opens on the low, pushes up. Like, it must be buying, right? Price a gap down, open on the low of the bar, and then pushes up. Like, as soon as the market opens, buyers are stepping in. And then what do you notice? Tight, 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 tight. And look at the low volume. Tightness and price, low volume tells you what about supply? There ain't that much supply coming to the market. Look at the relationship of price to the 10, the 21, and the 50 SMA, the purple line. They're like that, really tight. Again, price movement patterns are occurring with slight variations, as Livermore said. This one here, this is ALGM. So look at this here, just looking at this trigger bar. Again, this is optimal trigger bar action to see on the 1 hour chart when you drill it down and you see potentially a trigger bar forming on the daily chart. These are the type of things I look for. So the first bar here, this is a gap down reversal bar. So the prior close is here at about 33.40. Price gaps down, opens here, shake out demand tail, shake out those weak hands, and then it closes on the high of the bar. What do you notice about the volume? There ain't much volume relative to the 30 bar average. What does that tell you about supply? There ain't that much supply there. And then what do you see? Tight, 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 tight. And look how the volume generally dries up. Large operators are most active first hour, last hour of the session. Here we go. BYSI. Here, gap down reversal bar. The prior close is here. Price gaps down. Little shake out demand tail as well. Recovers. Tight, 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 tight. 1021.50. Look how the volume dries up for the rest of the session. Isn't that interesting? PL. SE, little gap down reversal bar. Prior closes here, gaps down, opens on the low of the bar, pushes up. The buying was immediate. And then look, tight, 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 tight. Look how the volume generally dries up. That's fantastic. Last hour, volume pops a little bit, but it's a tight range bar with volume about double the 30 bar average. Absorption of supply. Tight bars with high volume, absorption of supply. Tight bars, low volume, very limited supply coming to the market. Key concept. ELF. Bullish synchronicity, I call this. There is a synchronicity between what price is doing and what the volume is doing. Volume increases, what does price do? Opens on the low of the bar, pushes up. This is the first 1 hour candlestick, and it opens on the low of the bar and then pushes up. There's an immediate presence of demand. So you're really studying this from a supply and demand perspective. What is going on from a supply and demand perspective? And then tight, 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 tight. GOTU. Here. Look at the tightness coming through in here. This is a shakeout demand tail. This is a gap down reversal bar with a shakeout demand tail. So see the prior closes here, price gaps down, opens here, shakeout demand tail, recovers, tight, 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 then here, shakeout demand tail. So the prior closes here, shakeout demand tail, it opens here, moves down into a session, and then what do you notice about the volume on this shakeout demand tail? There ain't much volume. What does that tell you about supply? There ain't that much supply. And then look, tight, 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 and look how the volume dries up. What is that telling you about how much supply is coming to the market? There ain't much. So again, this video is going to be long. This video is going to be extremely thorough and extremely in-depth, but it's coming at things from these things keep happening. And they keep happening from a supply and demand perspective, which is why it's timeless. You will see the same action happening on the monthly chart, the weekly chart, the daily chart, the 1 hour chart, the 1 minute chart, the 5 minute chart, the 15 minute chart, all charts. It's literally supply and demand. Like it just keeps happening time and time and time and time again. Leading stocks act in very repeatable ways because it's usually the same people involved who have repeatable behavior traits, how they are acting, how they are operating in the market. So you're really trying to study the stocks from personality perspectives and understand supply and demand in terms of interrelatedness of price, volume, repeatable characteristics to the moving averages potentially means something. Like studying it in a ridiculously deliberate manner. Like stupidly deliberate, like go into it. TTD, slight variation here because price is below its 50-day, but this was a shakeout demand tail onto the 21-day EMA on the daily chart. You may see this one later on in the presentation. But you see here, look at the tightness in price for this final session before the stock makes a huge move here. Look at what was happening. So this is all about pivot points. How do pivot points form, these pivotal points? How does the line of least resistance form? How do you know when a stock is ready? It's things I'm trying to teach you in this video. Do you see here, this shakeout demand tail, what do you notice about the volume? This is also undercutting the confluence of the 21-day EMA on the daily chart. What do you notice about the shakeout demand tail and the level of volume? Volume's about half the 30 bar average. What does that tell you about supply? There ain't that much supply coming to the market. Interesting. Then what do you see with the next bar? It's a tight inside bar on low relative volume. What does that tell you about supply? There ain't any supply coming to the market. Isn't that good? Especially if it's then potentially setting up in a pivot and it's trigger bar type action then on the daily chart and it's favorable risk versus reward trade. These are the clues that I'm looking for. These are the things. Unity as well. Shakeout demand tail here. Volume pops up a little bit. So what's that telling me about supply? Okay, there's a bit of supply. This was actually, then you've got to think about things in terms of relationship of where are things happening on higher time frames. So here, this is actually happening in terms of the daily chart underneath the 21-day EMA, right around the 21-day EMA. Shake out those weak hands. So if you see gap down reverse bar, shake out demand tails, I think, especially around key moving averages, it's a sign of institutional support. Some entity somewhere is supporting the stock if I see things like this. Not always, it doesn't mean that the trade has to be a winner and stuff like that, but this is how I'm conducting the analysis. And then look, in the last 4 hours of the session, tight, 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 and look how the volume dries up. Not much supply before the stock then powers out like this. It's trying to follow the institutional footprint. GFAI, before this stock powers out here and you get this huge bar, what do you notice? Tight, 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 and look how the volume dries up. Isn't that interesting? Tightness and price, low relative volume, tells you what about supply? There ain't much supply coming to the market. LUNR, before this stock goes up from basically $40 to over $120 in the space of 4 hours, what does it do? A stock that goes from $40 to $120 in the space of 4 hours, what does it do? Are there repeatable traits to that I can identify and use as an advantage? I think there is. Look at this. Tight, 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 tight. Look how the volume dries up. So then it's all about creating asymmetric, favorable risk versus reward trades from this knowledge, from this kind of trigger bar knowledge. So the trigger bar to me is an indication that there's very little supply coming to the market. Can I now create a favorable risk versus reward trade? Because my expectation is price should power out through this. Like price should really rip through this level. That's the pivot point, the pivotal points. So let's do a couple more. So HB, so remember, these are these kind of older ones here. Some of the stocks are less liquid at this time, so it's kind of extreme examples. But from a pattern recognition standpoint, look at this. See how the stock moves up, pulls in to its 10-day EMA, the black line, and it just holds it. Like this is so textbook. Now here, price doesn't even move in this session, but imagine what that looks like on the 1 hour chart. Like price ain't moving anywhere. It's really good to see. And then this one here is KEX. KEX, hope if I could say 3 letters, wouldn't it? So see how it moves up here, pulls in. Where does the stock find supportive action? It's not chopping around all over the place like this. It's not going crazy. It's so orderly, it's so smooth how it's pulling back. So this smoothness in price is an indication that someone somewhere is supporting the stock. That's my belief. That's how I interpret it. So see how it just pulls back in here to the 10. Now, again, we're going to talk about where the entry is, where the initial stop loss is, but I'll give you a clue. It's through the high, initial stop underneath the low of the trigger bar, basically, which should then tie in with being at least underneath, say, the 10 EMA or the 21 EMA. Depends if it's sitting there or not. But what you will see is I pointed to trigger bars, but you will see the bar before would also be a trigger bar, right? The bar afterwards would also be a trigger bar. The bar before this bar here, this little shakeout demand tail underneath the 21, look how there's no volume, and look how it undercuts all the lows of this base. So you have this shakeout demand tail here on the day before this then trigger bar, but you have the shakeout demand tail, look how there's no volume coming through, and it undercuts all the base lows. What does that tell you about supply? Very much supply coming to the market. So that there would be a really good setup. Through the high, stop loss under low, that's also underneath the 21 EMA, then can you sit for the trend? As you're going to learn later on. KEX as well. So it's also understanding that stocks tend to have repeatable characteristics in terms of how do they move? How do they move in uptrends? How do they base? How do they then break out initially? How do they then trend there afterwards? What's optimal sell rules around that? So here you're going to see stocks as we go throughout. You're going to see, oh, that stock was 10 slides ago. It was the same stock, different time. Oh, it's now happened again. 20 slides later, 20 years later. Stocks, for whatever reason, just move in similar ways. It's just the personality of stocks. So here you go. Price pulls down, find support on the 21. Shakeout demand tail. What do you notice about the volume? There's not much volume. Shakeout demand tail holds above the 21. And then look, pulls into the 10. Tight, tight. Look how the volume dries up. That's really good. Here, pulls back down. Look how orderly the pullback is. It's not chopping around all over the place. Note how clean the charts look. They're ridiculously clean. Look at this, trigger bar there. So it's all about really tight asymmetric risk reward trades. Then you're going to learn later on about how to optimize the profits and potentially going lower the bar, lower the bar, lower the bar, lower the bar, and choking some off. So here's another one. This is KEX again in the second half of 1980. So see how it basically moves in a stair-step fashion. Ready? Goes up, sideways, goes up, sideways. See how it pulls in here? Look at the tightness. Look at all these blue dots. This is 52-week highs on the relative strength line versus the S&P 500. The stock is screaming at you. It is a leader. Here, pulls up. Where does it find support? On the blue line. On the blue line. Nice shakeout demand tail. What do you notice about the volume? There's not much volume. What does that tell you about supply? There ain't that much supply. So this is really good action to be dialing it in, training the pattern recognition to. KEX in 1981. Doesn't this chart look really similar to these charts here? Like, as Livermore said, it's recurring patterns. He was convinced about it with slight variations. It's understanding the concept. Trading's not complicated. It's really not that complicated. There's some really sound basic principles to learn, and then it's all about execution. Like, it's not that difficult. A lot of it is pattern recognition and then some basic understanding around risk management. So see here how it moves up, pulls in. Where does the stock find support? On the black line. It's not chopping around all over the place. Find support there. Look at the low volume. Powers out. Then you get one over here as well, and I'm going to teach you about risk mitigation. So here, through the high, stop loss under the low, free roll into that, and then you knocked out break even rather than the full stop. Going to learn about that a little bit later on. So planning the trade. So what we're going to do now is we're not going to go into the risk mitigation on several. I'm just taking you through slowly, one slide at a time. So this here, couple of slides on planning the trade out. So creating favorable risk versus reward trading opportunities. So let's say ALGM. You think as building this cup and handle, found supportive action on the 50. It's not one of the strongest of the strong stocks because ideally it would have held above its black and blue line, but it's a really good example here for the intraday action. So imagine you see this bar here and you're like, well, it's sitting on the 10 EMA. I'll show you the intraday action. So this is how I'd be thinking about it. Let me go forward a slide. So this is then looking at that daily trigger bar going down onto the 1 hour chart. We looked at this bar earlier on, the shakeout demand tail that then closes on the high, low relative volume, and tightens on the 10, 21, and 50 on the 1 hour chart, okay? So what I like to do is I like to target it through the high of the trigger bar, initial stop loss underneath the low of the trigger bar, usually by a penny, by a cent. But then I use buy stop limit orders. So a buy stop limit order, I've explained this in recent videos, but a buy stop limit order, I'm usually putting the limit around 0.5% to 1% above the high of said trigger bar for where I'm looking to enter. It all then feeds into risk control as well. So let's start talking about it. So in this instance here, I'd be using a buy stop limit order. So my buy stop, which is the trigger price, would be 33.48. So I'm waiting for price to go through that level. That is the trigger. And then the limit is how much am I willing to pay for shares, which in this instance here, if it was 0.5% above the high of the trigger bar, it would be 33.64. Now my initial stop loss, as I said, is usually 1 cent below the low of the trigger bar. If the low of the trigger bar is potentially $32.01, okay, I might put it down to $31.97 or 98 cents to be just underneath the round number. So I may do that. There may be some variation with underneath whole dollars and half dollar numbers, okay? But this then means it's really important for me. So then when you see all these other examples, be thinking how I'm then thinking about the trade. Okay, through the high of the trigger bar, limit it in terms of 0.5 to 1%, then think about that relative to the risk. So let's now talk about the risk element. So I need to know what is my maximum risk on the trade going to be. You could have a trigger bar on an extremely volatile stock where the initial stop could be 12%. I'm going to be anywhere near that. Like I want to be a low single figures in terms of my stop loss. I would say average is somewhere between 2% and 4%, maybe even 2% and 3%. Like it's pretty tight. Why? Because if you look at the ADR percentage and you may be like, what the is that? Average daily range percentage. This is set to the last 20 days. It does not matter if you use 15 days, 20 days, 30 days, 40 days. I'm basically looking for price in terms of, my initial stop in terms of percentages versus the average daily range percentage, which is the average daily percentage move excluding gaps of the stock over the last X amount of days, in this instance here, 20 days, to be less than that. Ideally, it is half to 2/3 that. Like that's really good, and I'll explain a little bit more about that on the risk mitigation side where I'm then teaching you about free rolling trades. But what I've got to do is calculate it from kind of an ideal scenario that I get filled pretty much right there at the high of the trigger bar, but also what's the maximum amount that I'm willing to pay for any shares. So if I get filled at 33.49, a penny above, my risk on the trade would be 2.68%. That's my risk on the trade, not risk to the account. Here, if I got filled at 33.64, my risk on the trade would be 3.13%. So my risk on the trade when I'm planning this out, and I do all my work when the market is closed. Like I do all of this when the market's closed. I'm already planning out when the market's closed. The market's not open and I'm doing this. I wait for the market to close. I do my homework at the evening. I create my plan for the next day, the night before. That's how I do it. Works well for me. So here, my risk on the trade is going to be somewhere between 2.63% and 3.13%. And it might be price just gaps up above that, pushes up and goes. That's fine. There's always another bus. There's always another leading stock that will set up. But in both instances here, the risk is favorable relative to the average daily range percentage of 3.48%. So obviously more favorable if I get a better fill on the trade. So that's how I'm then planning out. And then we're going to talk about later on. Here it is. And then you see trends pretty well from there. Let's then do EXPI. Slight little variation here that you're going to see in some of these is price pulls back down, finds supportive action around the 21 EMA, bounces, pulls back down, finds supportive action around the 21 EMA. Like it's sitting right there on the 21 EMA. It's coming down to the prior base lows, and what you notice about the volume. there ain't much volume. So I don't shy away from these type of trigger bars sitting around key moving averages if I think the risk is favorable. So higher the bar is 1910, lower the bar by a penny is 1865. 0.5% above the high of the trigger bar there would be 1919, which is 9 cents above. So the risk on the trade is going to be somewhere between 2.43% and 2.83%. Now, relative to the ADR percentage over the last 20 days, excluding gaps, is 5.49%. Both of those are very favorable. Okay, the first one is around about half that. That's really, really, really good. Under half that. This is what it looks like on the 1 hour chart. So again, it's the confluence of thinking about where are you seeing things. Like, think about it really deeply, like really study the charts. There's a lot of clues there. So as price pulls back down here on the daily chart to the 21, low relative volume. What does that tell you? Okay, that's interesting. It's low relative volume pulling back down to 21 EMA tight bar, tells me there ain't much supply coming to the market. Then we take a look here on the 1 hour chart. Okay, first two bars, certainly the first bar, okay, it gaps down, but it's a tight little doji bar on increased volume, absorption of supply. The last bar is also signaling absorption of supply. Tight bar, increased volume. Absorption, large operators, most active, first hour, last hour. Both of those two bars are signaling absorption of supply. Everything in between is basically tightness in price and low volume. What does that tell me? There ain't much supply coming through. And then it's in an area I'm expecting the stock to be supported at the 21-day EMA. And then is it a favorable trade? Make sense? Let's do a couple more. ALK, Alaska Air. We're in the 1980s. So here you go. Moves up here, pulls in, see how it finds support on the 21-day EMA, and then tightens. Look at the volume coming through. Now I'm going to give you another subtlety here. Again, I want to give you lots of I don't want to overload you per slide as slides come up, and we are on slide 35 at 241. There's a little way to go here, but as slides come up, I want to give you kind of little pockets like, did you notice this? Did you notice this? This is important. This is why it's important. So on this slide here, let me give you one of those. Look at the relative strength line pre-base, 52-week highs coming through. As the stock bases, the RS is actually good. It actually starts trending up here. And then the day before the trigger bar, so on this day here, the stock is still in the base. And what do you notice about the relative strength line? Hits a 52-week high, as indicated by this blue dot. So you have a stock that hits a 52-week high and it's not yet broken out of the base. That's the proverbial basketball being held underneath water. Like, the stock is trying to go higher, but the weight of the market is just pulling it down at the minute. So 52-week highs in a base, I think, is an extreme sign of strength, in conjunction with other things like holding key moving averages, tightness in price, so on and so forth. 1983, Pratt. See how it moves up here and then it pulls in, extremely a liquid stock, but liquid stocks, it's the same thing. It's just supply and demand. See how it holds the 10, tightness, extreme tightness, and then it goes. As we get more to present day into like the 90s and 2000s, you're going to see more and more liquid examples. See the tightness, then it goes, and we're going to talk about lower the bar, and some of the optimizing rules a little bit later. Berkshire Hathaway on the monthly chart. So we've primarily been looking at daily charts. Let's take a look at the monthly chart. Has anything changed? So it's the monthly 10 EMA that I put on my charts, which are going to be important when I give you some stats later on where these breakouts actually occur in relationship to the NASDAQ and its monthly 10 EMA. Side note, 90% occur above in a month where the NASDAQ comp closed above its monthly 10 EMA. 90% of 3,000 in my database. See how it moves up here? Look how just nice the trend is. See how it's not chopping around. It's not like this. It's not chopping here. No, it's just, look at it. It's just like lovely how it moves. It's so smooth how it moves. This is then really important from a trade management standpoint as I get ahead of myself a little bit, because if you're going to use a moving average, 1 or 2 moving averages, or maybe 3 as a trailing stop loss, so then you're looking for closes below, well, you want to see on the prior rally and prior base breakouts, the stock respected those moving averages. Why? Because the characteristic of the stock, in my view and Livermore's view, is likely to repeat in a similar fashion. So see how it pulls in, finds support on its monthly 10, and then it's this trigger bar, even on the monthly. Look at the tightness and price. So remember, now when I'm showing you these bars, think through the high of the bar, stop loss, initial stop loss underneath the low of the bar. So be thinking that. I haven't drawn it on, otherwise the charts are going to get really messy. I've done it with a couple of examples where I kind of pause and then go through some. But here, be thinking through the high, stop loss under the low, and then we're going to go into the free rolling and we'll talk about the sell rules. So that's why I said earlier on, like watching this video twice, when you get all the knowledge, by the end of the video, when you watch it back, you'll be like, oh, that makes sense. I get it. This one here, see how the stock powers up, pulls into the 10, holds it, but this flag type pattern here, look at the trigger bar, opens on the low, it's an inside bar, opens on the low of the bar, close on the high of the bar, low relative volume. Think about what that potentially looks like on the 1 hour chart when you then do the multiple time frame analysis. Again, the setup would then be through the high of the bar, initial stop loss underneath the low of the bar. Nice, ain't that difficult. LZB, nice move up here. See the respect for the 10 initially, then the blue line, the 21, then you get the trigger bar, look how the volume dries up, look at the 52-week highs over here, and then it powers up. Skywork. So now we're going to go into planning the trade plus the risk mitigation. So here I'm going to take you through what I call free rolling. So here you get this more of like a cup and handle type pattern, this being the cup, this being the handle. I wouldn't get caught up on semantics that this is a cup and handle, this is a flag, this is a pennant, this is a wedge, this is a dart. It doesn't matter. Like, what's happening from a supply and demand perspective, and is it a repeatable setup? Is it a favorable risk versus reward trade? Is the most important thing to be focusing on. Great reaction to the earnings, pulls down, finds supportive action. Where? Around its 21-day EMA, bounces, puts in this really tight handle, volume dries up. See how you get a 52-week high coming through on the breakout. That's really, really, really good. So this tight bar here sitting on the 10. So again, through the high, stop underneath the low. Let's see what that looks like. So then when we're planning the trade out, it looks like this. Okay, through the high of the bar, 28.70, initial stop sent below at 28.06. And then if I'm looking to get filled within 0.5%, the limit on my buy stop order would be 28.84. So then I know my max risk is going to be somewhere between 2.26% and 2.7%. That's really important for me to know from a risk mitigation standpoint. Let's go into the risk mitigation. So what I like to do is invariably sell 1/3 at 2 times my initial stop loss or my new stop loss. New stop loss for me could be moving from the low of the trigger bar to low of the breakout day. Okay, that's something that I keep open and I do quite often. If it's a healthy market, invariably I'm taking off 1/3 at 2 times the initial stop loss or 2 times the new stop loss at low of the breakout day. If it's a much choppier market, I may be quicker and I will take half off at those levels, low of the trigger bar or low of the breakout day. Depends how the trade plays out, depends how I'm feeling about it, depends what I'm seeing going on. Again, this is trading at a high level. Like, it's about reactions. You can have, as Mike Tyson says, you can have the perfect game plan, but when you get punched in the face, that whole thing can kind of go out the window. So I'm not saying my old trading plan goes out the window, but I got different variations for how I'm thinking about it. Like, I've got those of you who are F1 fans, okay, you'll hear them over the radio. Okay, we're gonna go to plan C now. Oh, now we're gonna go to plan F. Now we're gonna go to plan H. Like, things change. Whether it be an F1 race, whether it be a football, whether it be a boxing match, whether it be trading like this, like, things change. Things happen in the market. Deal with it. Darwinism, those that can adapt survive. Like, it's all about adaptation and adapting quickly. So I'm just going to show you here in this example, free rolling at 1/3 at 2 times the initial stop loss. So here it is, right? Say the entry is in here. So entry 28.84, which was the limit on the buy stop limit order for 3,000 shares. So total invested $86,520. Stop loss at 28.06, which is down here, sent below the low of the trigger bar on 3,000 shares. Means the risk on the trade is $2,340. Why? Because the risk is 78 cents times 3,000. So here it is. This is the 78 cents from where the entry is here, 28.84 in this hypothetical example. So 1/3 of the position at 2 times the initial stop loss. So 1/3 of 3,000 is 1,000 shares sold at 30.40, which equals $1,560 profit locked in. Why? Because it is a $1.56, which is 2 times the risk of 78 cents times by the 1,000 shares. The stop loss at 28.06, we've kept the initial stop loss down here. On the remaining 2,000 shares equals $1,560 worth of risk. Why? Because it is 78 cents times by 2,000 shares. Because remember, there's still 2,000 shares that were purchased here at 28.84, and the stop on those is down here at 28.06. So there's risk associated with them. So $1,500 profit locked in minus $1,560 remaining risk equals $0 if stopped on the remaining 2,000 shares at 28.06. Position free rolled. So now, when we're going through the examples, and we'll do a couple more, we'll do RCL here. When we go through a couple of these examples, okay, be thinking, when I haven't laid them all out like this because I think this would then be like a 10-hour YouTube video, maybe even like 15, 20-hour YouTube video. I don't know, you probably get bored of me after a couple of hours. But when you're then seeing the examples that I haven't marked up and I'm literally just pointing to the trigger bars and we're doing the historical examples in chronological order, be thinking about this. Okay. Targeting through the higher trigger bar, initial stop loss there, getting in within 0.5 to 1% of that, then thinking about the free roll, thinking about those levels as well. 1/3, 2 times initial stop loss, maybe it's 2 times low the breakout day, maybe it's half. Again, play around with it, experience. Like as Livermore said, study the market, study leading stocks in a very deliberate, deep way. Those of you who have followed me for a while will know I preach deliberate practice. Like do everything in extremely deliberate, focused way. So here it is, tight little trigger bar in here, volume dries up, 52-week highs in the base, comes out of this cup and handle, starts finding support of action around its 10. Let's take a look. So this is what the trade would look like. High of the trigger bar is 79.18. If we go 50 cents, which is 0.64%, so let's say we went for 0.64, 50 cents above, that would be 79.68. That is the maximum in this hypothetical example we're looking to pay for any shares. So then we know what the max risk on the trade is, and it's going to be between 1.44% with the stop loss 1 cent below the low of the trigger bar and 2.07%. That's really helpful to know from a trade management standpoint. We would also want to know the ADR percentage, and ideally the ADR is pushing, say, 3% or something like that. 3% with a 1.44% initial stop would be very helpful. It'd be half the ADR percentage. Now the logic behind that is if the ADR percentage is 3% and the initial risk on the trade is 1.44%, if the stock goes up, remember it's the average daily percentage move excluding gaps over the last X amount of days. For me, I use 20 days. It really doesn't matter if you use 15, 20, 25, 30, 31. It really doesn't matter. But the point is, if the stock can go up over the last 20 days, the average daily percentage move is say 3% and the initial stop is 1.5% for all intents and purposes, then that means 1/3 would be 2 times the initial stop. So if we're then selling 1/3 at 2 times the initial stop, that matches up with the ADR percentage of 3% in this example. Make sense? So it is then reasonable to expect the position could be free rolled on day one if the stock does what it could do in the last 20 days. So it's all about thinking realistically and reasonably. So here, let's walk through this example. So here, let's say the entry here is at 79.68 and the initial stop loss is down here at 78.04, which would be 2.07% risk, which is $1.65. So entry at 79.68 for 3,000 shares equals $239,040 total invested. Stop loss at 78.04 on 3,000 shares means the total risk on the trade, and again there can be gap down, there can be slippages, there can be all sorts, obviously. $4,950 worth of risk, so that is $1.65 times by $3,000. So selling 1/3 of the position at 2 times the initial stop loss would be 1,000 shares sold at 82.98 up here, okay, 2 times. So remember, the risk on the trade is $1.65 and these here be selling at $3.30 2 times. So selling 1,000 shares at 82.98 equals $3,300 profit locked in, $3.30 times by 1,000. That's what I was just telling you up here. Stop loss at 78.04, so it's still down here. Haven't changed it on the remaining 2,000 shares equals $3,300 worth of risk. That's $1.65 times by 2,000. $3,300 profit locked in minus the $3,300 and $3,300 remaining risk equals $0 if stopped on the remaining 2,000 shares at 78.04. Obviously, you can have gap downs on earnings, slippages, broker downgrades, all of that stuff can happen. This is just hypothetical, explaining some points to you. 78.04 position, free rolled. Nice, right? So let's do some more. We're now into 1985. See how this stock here moves up, pulls in, finds respect on the 10, tightness in price, good RS line, no 52-week highs, but good RS line, and then starts going. Don't worry, you're going to learn about optimizing sell rules, lower the bar, 10 EMA, 21 EMA, all of that good stuff. Here's the Dow Jones industrial average in the 1980s, kind of a VCP, isn't it? See how it reclaims its monthly 10 EMA and then it holds it. It's kind of like VCP, right? It's kind of like stairs here. Holds it, contracts higher, and then the really nice trend. Look at the trend beforehand, look at the trend afterwards, and then see how it just pulls in here and finds support of action on its monthly 10 EMA. Pulls in, off it goes again. EBF. See how the stock powers up here, pulls in, look at the tightness in price. So again, think about this from a trigger bar standpoint. Through the high, stop loss underneath the low relative volume, get in, free roll it on the first day, ride the trend. And you're going to learn about riding trends and sell rules that I use around that. But when I'm showing you these examples, have in your head, like overlay it, like, okay, through the high, stop loss there, free roll it there, boom, sell it there. Now, does every trigger bar lead to a spectacular trade? Absolutely not. Of course it doesn't, but for me, trading is all about taking minimal risk and trying to capture lots and lots of upside. I'll repeat. HOV, see how here's down a trigger bar, see, trigger bar. So through the high, stop loss there, ride the trend. Here's another trigger bar. Ideally, you'd like it to be sat on the 10 EMA there. So see how it moves up here, shake out demand tail onto the 10, tight. Look at that trigger bar. Off it goes. You just see how they just keep moving in the same manner. Here you go. FMC, 1986. Good move up here, pulls in, finds support around its 10. Little bounce, pulls in, tightness, finds support around its 10. Now, if you get a really tight bar and high relative volume, you probably want to be looking at the 1 hour chart, right? See, how is it moving on the 1 hour chart? Is the 10, 21, and 50 there like that? What am I seeing? Am I seeing a gap down reversal bar, then a recovery? Am I seeing a shakeout demand tail, intra-session? Am I seeing, generally speaking, tightness and price? So it's this here. And again, you could call this a flag type pattern. You could call it maybe a Davis box, whatever you want to call it. But it's really trying to understand things from a supply and demand perspective. So let's go into the profit optimization. That sounds a bit fancy, doesn't it? So it's basically some selling guidelines. So this is my own analysis from looking at 500 different breakouts, recording the statistics. So the key ones that I want to be getting across is the average percentage move before close below the daily 10 EMA, 28.82%, and the average move before the stock closed below its 21 EMA on the daily chart, 42%. So 28% for the 10 EMA, and then the 21 EMA, 42%. So statistically, it's better to use the 21 EMA. Now, I didn't do this on the 50 SMA. Some people like the 50 SMA. For me, that's like a little bit too far away. For my personality, it works better, 10 EMA and 21 EMA, and then having the option to choke some off if I think price starts getting extended, which I'm going to be talking to you about. So now when we're going through, again, I'm trying to layer here, okay? I don't want to add complexity really quickly. What I'm trying to do in this video is layer complexity. Like it's not overly confusing or difficult, I don't think, but there's obviously complexity involved whenever you're learning a new skill. Trading is a skill. So I'm trying to add complexity as we go. So then when you start seeing things, now you're starting to notice, okay, how did the stock move? Okay, it did that in the rally, it pulled back down, it held there. Oh, then there's tight bars. Oh, and the relative strength line, 52-week highs, and the volume dried up on those tight bars. Then there was a shakeout demand tail and a gap down reversal bar. Where am I then looking to target? Okay, through the high of the trigger bar, stop loss goes there. How am I then looking to free roll it? Okay, it's one third at 2 times the initial stop loss, which could be below the low of the trigger bar, could move it up to the low of the breakout day. Maybe I do half off there, so selling 1/2 of the position at 1 times the initial stop loss or the new stop loss. Okay, that's cool. Now, how am I looking to stay in the trend? Because I potentially got half my position or 2/3 of the position. What am I looking to do with the 2/3 of the half that I've still got left? Now here we go, layering complexity. So remember, I've been blabbering on about black line and blue line. Now the black line and blue line are going to be really important because these percentages here are on the first close below the 10 EMA, which is the black line, the 21 EMA, which is the blue line. Making sense? Now I also just want to add in here. So this may look a little bit confusing at first, so let me just read it out to you. So this is my own research analyzing 3,000 breakouts from my model database from 1986 to 2022. 2,723 breakouts, which is 90.7777% for those of you that are mathematically orientated, occurred in a month where the NASDAQ composite closed above its monthly 10 EMA. The NASDAQ composite closed above its monthly 10 EMA 74% of the time. The 10-day and 21 EMA selling guidelines are better when the NASDAQ composite is above its monthly 10 EMA. You've probably heard the old saying, the trend is your friend. So these are the stats, actually adding some kind of proverbial meat to the bone on that the trend is your friend. So what this is saying is nearly 91% of the breakouts, let's just use round numbers because then you may remember it more easily, 90% of 3,000 breakouts occurred in a month where the NASDAQ composite, being this blue line, was above the red line. 90% of the breakouts occur when the NASDAQ composite is above its monthly 10 EMA from the stocks in my database. So you can see those periods of time in here, which is basically when the blue line is above the red line. The market's trending up, right? So think about the context of the market that you are trading in as well. So now when we start layering the complexity, okay, we're adding a few things here. So let's just look at this base here. Now you can say, oh, it's a VCP, it's Davis box, whatever you want to call it, that's fine by me. See how it starts holding around the key moving averages. This one here actually starts finding support on the 50-day and then it starts tightening on the 21. This here is a much better setup for me than this down here. But look at the tightness in price. So okay, now we're getting the trigger bar concept. What did you notice about the relative strength? Did you pick up on that? The day before this trigger bar, and the day before was also a trigger bar, but it didn't go through the high day. What do you notice about the relative strength? 52-week high. Do you see the blue dot? So the stock is in the base and it's hitting a 52-week high on the relative strength line. So the market on this day here and the day before as well, because it's back-to-back 52-week highs, the stock isn't going anywhere. The stock is basically flat, but what's it telling you the market was doing? The market was pulling down those days. So the market weakness cannot pull the stock down. It can't decline the share price of this stock. It's just holding up there. It's such a sign of strength when you see 52-week highs in a base. It's a ridiculous sign of strength, especially if it sets up like this. So now we're thinking what? We're thinking, okay, where's the entry? Through the high, initial stop loss underneath the low. First bar here, this looks like it's over 1/3, 2 times what the initial stop loss would be. Boom. Now we free rolled it, still got 2/3 of position. And then what were we saying? Black line, blue line. So you've then got 2/3 of the position, 1/3 on a close below the black line. Where's that close below? It's up here. So again, think about that in terms of risk multiples. Your risk was from here to here, and your gain was from here to here. Keep the risk control really, really tight. Tight stops, let it run. Tight stops, let it run. I'm an intermediate term trend follower. I'm not a scalper. I'm not a day trader. I may be active in terms of intraday to try and free roll the trade, but then I'm just trying to sit, chill out, relax, let the trend play. And I have no idea whether the trend is going to be 5%, 50%, 500%, or whether I get stopped out 5 minutes later. Lots of fives there. I have no idea. That's the nature of the beast. That's the lady luck. That's the variance involved. You have no idea. I have no idea. I have no idea. I wasn't buying this in 1988, clearly, but I would have no idea. I would have no idea from this that 2 days later, price is here. I don't know anything. Like, I literally don't know what's going to happen. I have an expectation of what's going to happen, but I don't know what's going to happen. That's why being adaptable. Okay, price did this. What am I going to do? What are my moves here? Remember the 4 things you can control. Remember, you can control when you buy, how much you buy, when you sell, how much you sell. That's basically all you can control in the market. Focus on that. Focus on what you can control. Not external things, not, oh, this person said this on Twitter, this person said this on CNBC. Who cares? Who cares? Here, find supportive action on the 10, on the 10, on the 10. Tight, 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 tight. Look how the volume dries up. Off it goes. We're going to talk about change of character bars a little bit later on. This is a big change of character bar. It's the opposite of what you want to see. Price opens on the high of the bar, closes on the low of the bar, slices down through the 10 EMA, volume pops up above the 30 bar average. That's a massive change of character. Be aware of that. It's about knowing when to follow the guidelines and when to break the guidelines. Here, EPAC. What do you notice about the stair-stepping fashion? Like, how did this stock move? And then I'm just going to fast forward to the end. Look at this. Bearish synchronicity. What was I just telling you on the last one? Look at this. Clear change of character. Livermore talks about, like, Livermore's just, he's just a genius. He's just the best trader who's ever lived. Just by an absolute country mile. Like, his wisdom is so deep. So deep. I know there was a tragic end to his life, which is very sad. But his wisdom in terms of trading, phenomenal. Absolutely phenomenal. He would call this the danger sign. So see when the stock starts acting wrong. So for me, change character, danger sign. What's a danger sign? Wide red spread candlesticks, wide red candlesticks that have a wide spread on increased volume, slicing through key moving averages. In particular, the 10 being the black line, the blue being the 21, and the purple being the 50. Like this here, change character. Not good, not good. But you see here how the stock moves. It goes up, stays above the 10, pulls in, gets tight into the 10. It goes up, pulls into the 1021. It goes up, pulls into the 1021. Look at the respect the stock has for its 21 EMA. Holds, 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 tight, trigger bar. So then I'm looking for the trigger bar to indicate, okay, stock's ready to go. See this here? Like, it's not by accident. It's not by coincidence. I just don't believe it's by accident or coincidence. It just happens too often. Look at this here. Before the stock starts breaking out, when's the optimal time to enter if you're thinking about taking limited risk and trying to capture the upside? Okay, through the high, stop there, tight trigger bar, volume dries up, poof, off it goes. In here again, look at the tightness in price, look how the volume dries up, look at the 52-week highs. The stock is yelling at you. And SCC goes up, finds support on the 20, tightens up. Look how the volume dries up. Look at the tightness in price. Off it goes. Very liquid stock. Liquid stocks are liquid stocks. They move the same. Berkshire Hathaway on the monthly chart. See how it moves up here? Pulls in. Tight bar. Trigger bar. Off it goes. That's what you're looking for. SIVB. See how the stock here moves up, pulls in. Look at the respect for the 10. Look at this tight little trigger bar. So remember, when I'm talking about this, think about through the high, stop underneath the low. Off it goes. That's 1989. Now let's talk about selling guidelines expanded. So when to choke off the position. So this for me is prudent times to be thinking about going lower the bar, lower the bar, lower the bar. Why? Because extended stocks, in my experience, can become much more extended. And as I said, I don't know whether it's going to go 5%, 50%, 500%. I have no idea. Not the foggiest. No idea. I just want to be there, ride the trend. So just because the stock is up 10%, I'm not just going to sell my whole position randomly because I'm up 3 times my initial risk. I couldn't care. Like, I want to ride the trend. Ride that trend right till the end, as Ed Sakota says in the Whipsaw song. So you see here, see how it starts moving up. So even if this bar here, you're like, it's so extended. lower the bar, lower the bar, lower the bar. Now this bar here is ridiculously extended. Huge supply shoot, huge gap, and then it's the supply shoot. Price is trying to go up, and then buyers push it back down, and then you get a huge change of character the next bar. So for me, what I keep open is, yes, I'm looking for closes below the 10 and 21 EMA. Like here, this is a huge change of character. But if price is extended on a short-term basis, I may think about choking off my position, some or all of it. It depends how extended. It depends what else am I seeing. But that's what I keep open. CRMT, so another one, just to show choking off the position. So you see here, see how it just starts moving. Now clearly, it's a little bit short-term extended, isn't it? The stock has just gone from, this will be split adjusted 101 times, 65 cents to $4.50 in the space of 2 weeks. Lower the bar, 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 lower the bar. Part or all the position. That's what I would do. It's not that difficult. Like part or all of the position. Lower the bar, lower the bar, lower the bar, lower the bar, lower the bar. Nicholas Darvis, had an excellent quote in his book, How He Made $2 Million in the Stock Market. His stop loss was his delegate. He would just let his stop loss decide. Like, I just let my stop loss decide. I will just put my stop on all or part of the position. If I think it's extended on this day here, I'll just go stop loss, lower the bar. Oh, still looks extended. Stop loss, lower the bar. And I will do that at the end of the day. Maybe in the last 5 minutes, I'll just adjust my stop loss there, or ahead of the session opening the next day. Just move my stop loss there, move it there, move it there, move it there. It's not that difficult. LEDS. See the tightness in price, bounce off the 21, then it gets tight on the 10. Look how the volume dries up, starts powering up here. So say on this day here, this supply shoot, this huge supply shoot here. So this is price trying to go up and sellers are bringing it back down. Okay, lower the bar. Next bar here. Okay, this is pretty extended, isn't it? The stock's just run from about $9, up to $29, $30 in 2 weeks. It's pretty extended, right? Lower the bar, lower the bar. So there's times where it may not necessarily make sense to wait for the stock to then come all the way back down and close below its 21. Like, common sense. It ain't that common, but like common sense. I have a toolbox of how I think about things. I'm willing to change how I was thinking about managing a position when new information becomes available. So as new information becomes available, I adapt what I'm doing. That's a Bayesian way of thinking, a Bayesian mentality. If you haven't read about creating a Bayesian mentality or what Bayesian means, go and study it. Like, the market is the most Bayesian thing out there. But I think having that Bayesian mindset, being open, being flexible. Okay, this happened, I'm going to do that. Any of you that have played sport at a high level or do anything to a high level will know, as new information becomes available, circumstances change, you have to adapt. You have to change as well. Like, it's great having a game plan, but as new information becomes available, I have to change to that. Because I may have been thinking, yeah, I'm just gonna hold all this back for the 10 and 21. But then suddenly price goes up 200% in 2 weeks, and I'm like, oh, hang on a minute. And then I see big supply shoots and potentially climactic volume. Adapt. GME. Like, who thought this here? So if you went lower the bar, imagine this day here. Imagine this day, you're like, this is stupidly extended. Or imagine you're some like short-term swing trader that bought it here and sold it out at like a 5-10% gain. You're like, look at me. Well, okay, but if you basically just followed some simple sell rules, you could have been locking it in here at like 1,000% gain. Like, if you had, again, I think position size is also important. My position size, I try and shoot for about 15% of account, and then when I take off a third, I've still got 10% of my account in a stock risk-free. That's how I'm trying to trade. So I've still got 10% there risk-free. So if you had 10% of your account and you literally just went lower the bar, lower the bar, lower the bar, and then adjust it here, just putting your stop loss there, that's around about 1,000% gain you're locking in on 10% of your account. That's added 100% to your account. You haven't just flipped it out here because, oh, I'm at 10%, I'm at 2 times my risk. Well done. But the stock went up 1,000%. Well, not more than 1,000% up here. But that's the thing about, you never know. Like, you never know whether it's going to go up 5%, 50%, 500%. You have no idea. And that's the thing about variance. But getting these big ones right, like getting these ones right, I think is so important. Tesla. This is, again, climactic behavior, right? See how it tightens up on its 21 in here? Then look at the trend. See the respect the stock has. It doesn't close below its 10 EMA. Just rides it. Then here, this is the largest volume ever on Tesla on this day here, and it's the context. Where are you seeing the largest volume ever, and what is price doing? What is the interrelatedness between price and the volume? Like, what is it doing? What's the interrelatedness between what price did and volume did, and what's the context? Price, volume, context. It's really important. So Tesla here has just ran, this will be split adjusted, Tesla's just run from about $23, $24 to $60 in, what's that, 2 months? And then it's the largest volume ever. So price is just, it's over 100% gain. What's that? About 150% gain. And it's the largest volume ever. Soon after the earnings. Are institutions more likely to be accumulating or distributing up here to giddy retail traders? What do you think? Lower the bar, lower the bar, lower the bar. So here it may not make sense to be keeping some back for a first close below the 21 because the stock is basically just gone for Tesla parabolic. And Tesla has a previous behavior of going parabolic. So it's understanding the stock you're trading, understanding the context, which takes experience. SMV, we're now into the 1990s. Good move, bounce off the 10, tightness here, trigger bar. So remember, when you're then seeing these trigger bars and I'm just pointing to them, through the high, stop loss under the low, free roll it 1/3 at 2 times the initial stop loss or new stop loss, ride the trend. And sometimes this is going to happen. I didn't want to just show you stocks that all go up 1,000% because they don't. Trading is in the trenches. Like, it's not easy. Like, this is going to happen. You have a good gain, you free roll it here, and then you get stopped out part here, and you're like, it could have been such a better trade. But it is what it is. 5%, 50%, 500%, 5 minutes later you get stopped out. You don't know. Such is the variance of it all. SIVB. Good move here, pulls in, finds support on the blue line, the blue line, the blue line, tightness, low volume, off it goes. Now up here, if you start thinking it's extended, lower the bar, lower the bar, lower the bar, lower the bar, chokes them off. Again, I either chokes them off, I wait for a close below the 10 or the 21, but if I certainly see behavior like this, which is a clear change of character, I'm out very, very quickly. SHYF, this is a brilliant example for how leading stocks move. Look at all the 52-week highs. This tells you the stock is a leader. Bounces off the 10 here. This is brilliant. Like, this is absolutely textbook. So it just goes sideways. Really nice consolidation. Shake out demand tail. See the support on the 10. Tight, tight, tight. Look how the volume dries up. Powers up. Bounce. 21 EMA here. What do you notice? Pull back to the 21-day EMA. Now the expectation is the stock will be supported around its 21-day EMA. What are you seeing? Supportive action. Shake out demand tail. What do you notice about the volume? There's sweet FA in terms of the volume, and it's a shake out demand tail onto the 21 in a leading stock. What's that telling you about supply? There ain't much supply coming to the market. Can you create a favourable risk versus reward trade? What's it like relative to the ADR percentage? Here, powers up, shake out demand tail onto the 21, tight little inside bar. Look how the volume dries up. Trigger bar, through the high, stop loss there. Remember, the intraday analysis as well. I'd be going down to the 1 hour chart. Now, I was not trading this in 1991, but if I was, I'd be going down to the 1 hour chart. Okay, what's it looking like? Are the 10, 21 and 50 SMA there? Is it tight? Was there a little shake out demand tail? Then tightness for the rest of the session. Make sense? This here, huge change character bar. This is the Livermore point, danger signal, like massive danger. Look at that. Opens there, closes there, widespread volume pops, highest volume since the move begun. What do you think institutions are doing now? They ain't buying. SCG, see the tightness in price. Look at the respect the stock has for its key moving averages, then the move up here. So remember what I was talking about, lower the bar, lower the bar, lower the bar, lower the bar. Look how effective it is. Imagine here if you think, this is so extended. Lower the bar, lower the bar, lower the bar, lower the bar, lower the bar. Just choke it off. Have a toolbox. Sky W. See how the stock moves up here, pulls into its 10. Look how the volume dries up. Look at the 52-week highs while the stock's still within the base. So here it finds support on the 10, bounces, pulls in, gap down reversal bar. So think about this here, okay, from a supply and demand perspective. This bar here, our expectation is even in 1993, the stock finds support action around its 21-day EMA because it is a leading stock. Look at the volume coming through on the breakout. Look at this volume coming through here. Look how the volume then dissipates, dries up on the pullback here. Look at the 52-week highs. The stock is a leader. Gap down reversal bar. So it gaps down. The open of this bar is on the lower of the bar, and then it pushes up. What does that tell you about the immediate presence of demand? Buyers were stepping up immediately when the stock opened. They must have done. Why? Because price gap down opens on the lower of the bar and then pushes up. Buyers must be there immediately. This is a really good sign if you think about someone somewhere who has a lot of capital is supporting the stock. Look how the volume dries up on that bar. It's below the 30-bar average. Isn't that interesting? Gap down reverse bar underneath the 21-day EMA. First pull back to the 21-day EMA since this move has begun on this chart here, and there's not much volume. What does that tell you about supply? There ain't much supply. And then the tightness and respect for the 21 EMA. Look at the change character coming through over here. CRMT. Tightness and price. See how it moves. Lower the bar, 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 lower the bar. Pretty effective, right? COHU. See how the stock moves up here, finds support on the 10, bounces, finds support around its 21. Look at the trend that unfolds here, and then it pulls down, starts finding support around the black and the blue lines, tightness, trigger bar actions. Remember, through the high, stop underneath the low. Look at these change character bars. See this slice through the 1021 EMA, and then the massive break that comes the session afterwards. So be thinking about potential sell rules, choking it off, closes below the black line, the blue line. Again, trying to take minimal risk, capture lots of upside. BBY 1993. See how the stock moves up here? Look how it's ridiculously tight, and look how the volume dries up. Look here, and then look at the trend that unfolds. So if you're then targeting it here, through the high, stop loss underneath the low, free roll it early, sit, exit part there, exit part here, or exit part here. It's not too difficult. LYTS, so another area to be looking for supportive action can be the 50-day moving average as well, certainly if it's a bigger base. So you see here just the first two, see how it's finding support on the purple line, which is the 50 SMA as well. So it's not uncommon to see these kind of setups that I've been blabbering on about now for over an hour to occur when you get the 1021 and the 50 SMA, so the black, the blue and the purple line do this, and you get the same tightness. So you see it in here, this is 1995, nothing's changed. Tightness and price, low volume, 52-week high previously. See how the 50 catches up in here? And the respect the stock has for its 50-day tightens in here. So again, when a stock is respecting its key moving averages, such as the 10, 21 and the 50, it is, to my mind, more a sign of institutions. Some large entity somewhere is supporting the stock, which is good in my book. See here, you also then get the 200 SMA where it perfectly bounces off of it. 200 SMA can be a longer term moving average. Some large entity somewhere steps up and support the stock. So you see it in here, you see it in here. So if you then start picking up all these clues, that's interesting. The stock got perfectly supported on its 50 and here, then it perfectly got supported on its 200. Looks like someone somewhere is accumulating this stock. It's never just one thing, it's a collection of things, and you're trying to piece all those things together, right? And then the tightness that comes through here, and then look here, go sideways, tight, go sideways, tight, go sideways, tight, go sideways, tight. Makes sense? CECE is the next one. Big move, tightness and price, trigger bar. Goes up again, shake out demand tail underneath the 21. Look at the tightness and price that comes through, AN. Stock makes a huge move here. Something, for whatever reason, sparks this move here. The stock then goes from about $3 up to, what's that, about $7.50, $7 or so. And then holds the 10, little undercut, 21 starts catching up, tight, low volume, off it goes. Remember what I was talking about that lower the bar technique? Isn't that interesting? Lower the bar, lower the bar, lower the bar, lower the bar, even on this big supply shoot here. Lower the bar, lower the bar, lower the bar. And then you get this change of character here. So again, it's having a toolbox, it's having a framework about how to think about things. BEN. Franklin Resources goes up, pulls back, finds support on the 21, bounces. This could be, you could think about this as kind of a VCP, a cup and handle type pattern, and then look at the tightness, look how the volume dries up, all in those 52-week highs while the stock is still in the base. This one here, cup and handle type pattern, finds support on its 10, tightness there, gets out. That one there would have been over 1/3 or 2 times the initial risk, so take 1/3 out there and then stopped here, break even. Rather than a full stop, break even. So again, these tight bars can help you create more asymmetric or associable trades, in my opinion. But go do your own research, study them. Games Workshop, this is just an example of just no supply coming to the market. Look at it, it's just tight. This has been one of the biggest movers in the UK market over the last 20 years or so, okay? Tightness and price, but look how the stock is moving. Think about those stair steps here. Like, look at this. Goes in, pulls in, goes up, pulls in. Makes sense? Look at where the stock is finding supportive action. Look at the 52-week highs. SLM goes up, pulls in, 10 EMA. It's the same thing. I'm just going to play through a couple of bars here. Do you see how it's just the same thing? If I just keep going forward now, because we're on slide 80 of 241. Like, do you see how it's just the same thing? It's the same thing. Like, this here is a brilliant one. Goes up, look at the tightness. Look at the tightness. Like, remember what I said. Tightness in price and low relative volume is just a sign there is sweet FA in terms of supply coming to the market. Then what do you notice about this trend here? Up here, it's clearly extended. But remember what I was saying, 10 EMA, 21 EMA, but I keep the option open of lower the bar, lower the bar, lower the bar, lower the bar. Look how effective, lower the bar, 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 lower the bar. Let the stop loss decide. Let it decide. COHG, tightness coming through. I'll keep going forward till I find like a really nice one to be talking about. CTS, just see how the stock moves. It goes from $8 to $18. Like, how does it move? Why does it find supportive action? What does it do before it breaks out high? How can you identify it on a repeatable basis? How can you then target it? How can you create asymmetric risk versus reward trades? How can you free roll the trade? What are then some guidelines in terms of sell rules that you can implement? Like, what are they? What are then the danger signals that you should really be out of the stock? Like, look at these danger signals here. Really key to training pattern recognition skills too. eBay, look at the tightness that comes through. Look at the tightness, look how the volume dries up. Tightness in price, volume dry up, 52-week highs. That's what you want to see. SYM, Qualcomm, just the high tight flag, bounce off the 10, bounce off the 10, bounce off the 10. Look how the volume dries up, look at the 52-week highs. Now clearly here, this is like danger signals, it's getting extended. Like here, it's extended on this day here, right? Then these two bars here, price actually gaps up here, closes down here. Lower the bar. This bar here, okay, it's an inside bar, lower the bar. This bar here, it gaps up, sells off, lower the bar. So it's not always about 10 and 21 EMA, okay, then take a third off there. Like, have it in your head. These like extreme leaders in the market, momentum stocks, like this can happen. Like, it's not uncommon for them to kind of get really extended ahead of themselves. So again, having that framework of how to think about things, I think is really important. GAIA, you can see this from IPOs. I think there's maybe about 5 to 10 examples that look pretty similar to this in all of them, right? Tightness in price straight from the IPO. Tightness in price, low volume, setting around the 10. Look at the tightness, look at the volume, and then out it goes. Lower the bar, lower the bar, lower the bar. It's really, really effective. Or keep some back. Here, tightness again before it goes. So it's really understanding the tightness point. NYGM makes a move, pulls into the 10. Look at the support for the 10. Look how the volume dries up. Look at the 52-week highs. Look how the stock then rides in the first close is not below its 21 till here. And then look at the danger signals coming through thereafter. It's really important to study a stock very deliberately before the base, in the pivot, after the pivot, so around the breakout. How does it trend there afterwards? What are optimal sell rules or guidelines that can help you? Like, think about it. Look at the tightness, look at the 52-week highs. This bar here on the 21 EMA, it actually trades inside. It's an inside bar that trades inside the shakeout demand tail on the prior day, undercutting the 21. And look how the volume dries up. Extreme tightness. Look at this inside bar. Look at the volume. There's no supply. Through the high, stop underneath the low. Off it goes. That could be a song, couldn't it? Let's do some more. You can just see it's just the same thing happening. MTH, like, this is ridiculously good. Stock makes a nice move here, pulls in, shake out demand tail, little pop in volume, and then just tight. Look at the extreme tightness. Look at the volume drying up. Extreme tightness, no volume, tells you what about supply? There ain't much supply coming to the market. And then look, when you get the slice through the 21 EMA, often that can be, for me, I use the 20, I think the market's getting quicker and quicker. So I think slices through the 21 EMA, there's the end of the intermediate term trend. I actually consider the 50-day moving average to be the longer term trend. Like, the 50 for me is the longer term trend. The blue line here, the 21 EMA, the daily 21 EMA, for me is the intermediate term trend. The 10 EMA is kind of like the shorter term trend. So between the 10 and the 21, I think that's like shorter term trend and intermediate term trend, which suits my personality well. I know myself very, very well. Like, I know what works for my personality, what doesn't work for my personality. So some of this, it absolutely won't work for your personality. It really won't. EME. Look at the tightness. Look how the volume dries up. Over here, look at the tightness. Look how the volume dries up. Over here, look at the tightness. Look how the volume generally dries up. Then look at the danger signals up here. So hopefully you're taking this in and you're seeing, like, holy smokers, this just keeps happening. So here, right, you get a really good reaction around the earnings, pulls into the 10. So remember, it's not chopping around, it's just pulling in. Look at the tightness in price. Now the volume pops up, but it's a ridiculously tight candlestick. What is that telling you about supply? Supply is being absorbed. Think about the context here as well. It's being absorbed. So even here, this is where maybe it makes sense to look on the 1 hour chart, the intraday analysis. What are you seeing? Oh, okay, I've seen that. Gap down, reverse bar, shake out demand tail. That's where the high volume was in the first hour. Then it was just tight and low volume for the rest of the session. The multiple time frame analysis, I think, is really important. And then look, buying it here, through the high, stop there, ride the trend. First close below the 10 is there. First close below the 21 is there. So think about the minimal risk we're taking and everything that's being captured to the upside. Nice. There's just loads of them, aren't there? Like, it's just literally the same thing. Black line, blue line, stocks in strong uptrends. Look at the tightness in price. Look at the low volume. What does it tell you? Tightness in price, low volume. Where's the stock setting up? Shake out demand tail underneath the 21. Hold to 21. Look how the volume dries up. Look at the 52-week highs in the base. Look at the 52-week highs before the base. It's telling you it's a leading stock. CCJ, uranium stock. See the tightness? Moves up here. Holds the 10, holds the 10, holds the 10. Look at the tightness. Look how the volume dries up. Up, and away it goes. Let's keep going here. ECPG, kind of VCP, look to it. Little undercut of the 21, but what do you notice? It undercuts the 21, and here is actually a trigger bar. Undercut the 21, no volume, closes on session highs. That's a trigger bar. Through the high, stop underneath the low. Go gadget, go. And then look at this bar here. Extreme tightness in price, and there's no volume. What does that tell you about supply? There ain't no supply coming to the market. Deckers on the weekly chart. So this would be the 10-week simple moving average, which is very closely aligned with the 50-day moving average on the daily chart. Look at the respect for it. Shake out demand tail, inside week, sitting there, low volume, 52-week highs, great reaction to the earnings coming through. Ride the trend. And HTC, it's just the same thing. Games Workshop, again, look how the stock, when it moves from, this would be £4.75 because it's a UK stock, to £7.50. How did it get from £4.50, £4.75 to $7.50? Are you seeing repeatable things happen time and time and time again? Are you? We're now 112 slides in. Hopefully you are. SGMA, if not, you probably want to turn off the video rather than wasting your time. ENG. It's the same thing. This can sometimes happen. There'll be a better example of this a little bit later on, but sometimes you can get like a trigger bar and then earnings come out the next day, but it's better if like earnings are coming out after the close of the trigger bar and then it like moves through on the back of an earnings report. That can be quite powerful, but it seems to me that earnings sparked this move. Now, I was not trading ENG in 2003, but it seems earnings sparked this move. Someone somewhere liked it. Powers up, pulls into the 10, tightness, volume dries up, and away it goes. But up here, right, short term, it's extended. It's just gone from like $1.90 to $2.80 in the space of 3 sessions. Lower the bar, lower the bar. Axon. How does a stock go? This will be split adjusted, I believe. How does a stock go from under $1, so from 40 cents to 25 cents? Think about that. Built this big phase 1 base. This is in the bear market of the early noughties. Built this big. Those of you who studied Stan Weinstein's work, Richard Wyckoff and the price cycle. This is a big phase 1 base. Causality point, right? So the price cycle. There's 4 parts of the price cycle. Phase 4 decline, phase 1 base, phase 2 uptrend, phase 3 distributional top. Let me give you a little overview of it, okay? Phase 1 base. Law of cause and effect. This is a Wyckoff concept. Wyckoff, absolute genius. Interviewed Livermore many times. Had 3 laws. Law of cause and effect, supply and demand, and effort versus result. Cause and effect basically says bigger the cause, bigger the effect. Nice and simple, right? This here is a big old cause. It's a big base. Okay, big base in here. Then as the stock goes from 40 cents to 25 cents, what happens? In the last 114, 15 slides I've just showed you, I know we're not super zoomed in here, but do you see the general respect for the black line and the blue line? Do you see it? See where the stock is setting up. Black line, blue line, black line, blue line, black line, blue line, black line, blue line, black line, blue line. And then up here, what do you notice? What do you notice up here? Earnings comes out and you see the volume. It's the highest volume thus far. And the stock, from memory, this is about a 4,000% move from 40 cents to $25-ish, right? And now you get the highest volume. Large operators must be active. They must be. Look at the volume. What do you think they're doing up here? What do you think they're doing? Are they accumulating up here? Are they distributing? Well, you can see what happens there afterwards. So again, common sense. Think things through. This would also be in terms of base counts, very late in base counts. You can learn about that in O'Neill's very good book, How to Make Money in Stocks. Let me keep going here. Let me find you some other ones. Just this one here is ridiculously good. Like, look at the demand coming in on the earnings. Look at the demand coming through here. Pulls back in. Finds support on the 10. Pulls back down. Look at the tightness and price. Tightness and price, low volume. This is the concept of trigger bars, pivot points, line of least resistance. This helps me create asymmetric reversible trades. Why? Because the expectation is it just moves through the high, stop underneath the low, free roll it, ride the trend. Maybe chokes them off, maybe don't. Depends how it plays out, right? CLF. How does this stock go from $2.50 to over $6? What does it do? Where does it find support? Black line, blue line, black line, black line in here. Look at the tightness, look at the low volume, look at the 52-week highs. Like, these leading stocks act in very similar manners. CMCO, hopefully you're keeping track of the year that we're in as well. This one here, this is GDent, 2003, 2004. How does a stock go from $6.50 to $30? What does it do? Is there anything repeatable you can use to your advantage? Look at the tightness around the black and the blue line. See how it holds it in here. See over here. Look at the support around the blue line, the 21-day EMA. Look at the tightness and price here. Look at the 52-week highs. Look at the tightness in here. Little undercut, reclaim. There's then a little trigger bar in here. Do you see it? Little trigger bar. Gap down. Little gap down, opens on the low, closes on the high. Up, and away it goes. Like, there's so many trigger bars just on this chart. Like, once you learn to spot trigger bars, you'll see them everywhere. Like, you just see them everywhere. Gel. Type bar. Let me keep going. ASOS, UK stock. See how the stock here pulls in to its 10-21-day EMA, and look at the volume. Really good volume coming through on the prior rally. It's not chopping around. It's respecting the moving averages. Shake out demand tails, good to see. Shake out those weekends. Shake out demand tail, holds to 21. Then the 21 catches up over here. Tight, 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 low volume. Off it goes. Let me go find you an interesting one. I want to find one around the earnings. But you can just see as I keep going here, we're now into 2005. What have we gone from? 1970 to 2005? Do you notice anything different in terms of how these stocks are moving? What's the best way to trade them? I don't. I'm trying to find one around the earnings. Let me see if I can find one around the earnings for you. You see how it's just all the same stuff. It's all the same stuff. This one here gets ridiculously tight. Look at this. Tight, 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 tight. Volume dries up. Crazy good setup. Celsius. This here. See how the stock moves, pulls in, finds support around its 21 EMA. Tightness in here. Look how the volume dries up. Goes up again, builds basically this Davis box, finds support on the 21 EMA. Look how the volume dries up before it comes out of the base. Like that trigger bar concept, which hopefully is now really standing out, as we've done 143 slides on this now in terms of trigger bars, looking for gap down reversal bars underneath the 21, shakeout demantos. Maybe the gap down reversal bar or the shakeout demanto underneath the 21 is actually where the risk really makes sense. So again, thinking about the initial risk relative to the ADR is really important. Really important. And then how they move there afterwards. That's why I wanted to like play the chart forwards. You can actually get a sense of, okay, when a stock sets up like this, what are the danger signals to look for? Like this is a danger signal. This is a danger signal. This is a danger signal. Like what happens pre-base, during base, in the pivot, thereafter, and then how the stock trends and how the trend ends. So if you think about, I'm going to go on Newtonian physics on you for a minute as I find one which is like superior force. Okay, here we go. Okay, so Newtonian physics 101, right? An object in motion tends to stay in motion until acted upon by a superior force. So if you think about this here, as the stock starts basing, you're thinking about this from a supply and demand. So here, this is a little gap down reversal bar. So it closes below its 21 DMA, which is an area where we'd expect a leading stock to find support. It's already found support once here on its 21 DMA with a nice shakeout to Montel. What did you notice about the volume? There ain't much volume. What does that tell you about supply? There ain't much supply. Then it bounces, pulls back down. Now you get this shakeout demand tail. Price gaps down relative to the prior close, opens on the low of the bar and pushes up. There's an immediate presence of demand. And what do you notice about the volume? It's half the 30-bar average. What does that tell you about supply? There ain't much supply coming to the market. That's good. So then the stock starts trending. But up here, what do you notice? This is the danger signal. This is the stock being acted upon by a superior force. Up until this point, demand is in control. But now this is the turning point. Like this is, Livermore called it the danger signal. This is Newtonian physics. Object in motion, which is in motion, it's trending up, tends to stay in motion, i.e. trending up until acted upon by a superior force. So what does the superior force visually look like? It looks like this. Huge volume, climactic price action, volatile, wide spreads to the downside, opens on the high, closes on the low, all really volatile like this. Like this is the turning point. Let me keep going forward. Let me find some more like turning points for you. I want to find one around the earnings where it like tightens and really goes on the earnings. Here you go. Okay, so this one here, this can happen, okay? Stock is trending up here. It goes from, what's that, about $8 and then up to about $11 here, okay? So it moves up here, just under 50% or so. What's that, maybe a 40% rally or something like that. Nice shakeout demand tail on the way, we like that. And then it starts tightening up. You get a trigger bar here, and then you get a trigger bar here. Now, it's a trigger bar and the volume pops up a little bit, okay? But that's to be expected. Why? Because earnings are going to come out after close. And you may have to be a little bit suspicious and go, maybe somebody knows something and they've acted upon it. Maybe they have, maybe they haven't. I can't prove or disprove that. But you see how this stock is basing into the earnings. This is not uncommon to see. See how it's basing into the earnings, and then you basically get this trigger bar action on a little increase in volume. Oh, and do you see that 52-week high the day before as well? Isn't that interesting? Stock's already a leader. And then it moves through the high of this trigger bar on the earnings reaction. So earnings comes out after the close of the trigger bar. So the reaction is this bar here. So it's not uncommon to see a stock base. This is basically textbook Davis box, holds to 10, and then you get this bar here and then it flies out like that. Nice, right? Here is in, here I am, but here, the stock as well. Turtle Beach, we used to use this when we used to play Xbox. I remember that as well. So see this? Tight little bar like that. Look how the volume dries up. Nice. Let me go find another good one for you. Well, they're all pretty good. You can learn everything. Well, I don't know if you can learn everything, but you can learn a lot from studying charts, how they move. Coca-Cola on the weekly chart. See how orderly the price action is. So remember, tightness and price. Doesn't matter if it's Coca-Cola on the weekly chart in 2015 or whether it's a stock way back when in 1970s, 1960s, 1950s, 1910s, Bethlehem Steel, back in the early 1900s. They move the same. Coca-Cola. Tightness and price pulls into its 10-week simple moving average. Look how the volume dries up. It's a tight inside bar. It's a trigger week on the weekly chart. If you've seen one of my recent videos, you'll see I showed you these trigger bars and the concept on the 1-minute chart, the 3-minute chart, the 5-minute chart, the monthly chart, the weekly chart, the daily chart, the 1-hour chart. It's exactly the same thing. I'll show you a couple a little bit later on the 1-hour chart. Let me go and find another good one for you. But hopefully, even if I'm just flicking through like this, right, just see how they move. Sound Energy, this is a AIM listed oil and gas UK stock. Moves the same here. Really nice uptrend. See the respect for the 10 EMA. It's not chopping around all over it. Bounce off the 10, bounce off the 10, shake out demand tail, shake out demand tail, shake out demand tail. So here it goes back to back inside bars, and look at the volume. And look on this shake out demand tail 2 bars before the trigger bar. Look at the shake out demand tail to the 21. What do you notice about the volume? There ain't much volume coming through. What does that tell you about supply? There ain't much supply coming through. Here's a danger signal. Do you see the danger signal starting to come through? Do you see how when the stock is acting right, basing constructively, tightening up, kind of in the pivot, like the trigger bar behavior, which for me is the final piece of the jigsaw before I want to target it, and then the change of character. Like, look at the change of character. Look at the volume coming through. It's a danger signal. This stock here, we saw one, it was GAIA, I believe, earlier on from its IPO. Basically the same chart, isn't it? See, just basically Darvis box, shake out demand tail, tight, sitting on the 10, off it goes from $8 to $10, powers out like that. Same thing from a supply and demand perspective. Canopy growth, a wheat stock. See how it finds support of action, builds a big base. So think about the law of cause and effect. Holds around its 21, tight, volume dries up, off it goes. Nice. EXPI, ridiculously good setup here. Look at the positive price action coming through here. Shake out demand tail on the earnings. Trigger bar there. Tight. Off it goes. And then look at the danger signals. Like it's really, I think this video here, it's like really important to study what's going on in this region, like pre-base and in the base, and like trigger bar concept and thereafter. But also note, like, when are you tending to see on a repeatable basis these stocks not act right? As you're looking in the bases and you're trying to see, okay, that's interesting, they tend to be setting up around, and you may just think this is like wizardry, it's just voodoo hoodoo, what am I on about? Hopefully I'm now showing you enough examples to go, it keeps happening, it's going to keep happening, I think, anyway. But then also saying, okay, that tends to keep happening in the base, but is there something that keeps happening to signal something's changed in the stock? Like that danger signal. Look here, look how volatile the price action gets. Ridiculously volatile. The stock goes from being very orderly in terms of how it's moving to extremely volatile in terms of how it's moving. Orderly price action is an indication that there is absorption of supply and accumulation going on. Volatile price action is the opposite. It indicates distribution. That's how I think about it. Games Workshop, this is a ridiculously good setup here. Tight. Look how the volume dries up. Look at the 52-week highs. Stock doesn't close below its 21 EMA all the way until over here. And it gaps down, closes below, opens on the high, sells off. Look at the volatile price action that starts coming through up here. Volatility, sign of distribution. Let me go and find some other ones. Potentially good talking about this one here. Extremely tight candlesticks, even when the volume pops up, is more so a sign of absorption of supply. So tight candlesticks, low volume, very little supply. Tight candlesticks, high relative volume, indicates there is absorption of supply. Volatile price action like this, distribution. CGC, this is the wheat stock that we were looking at a little while ago. Look at the tightness and price, the respect for the 10 here. Okay, holds the 21, shake out demand tail underneath the 21, back to back inside bars, then it tightens up, there's the trigger bar, off it goes. Nice. Look at the volatile pricing. Like, look how this stock here then is not acting right. Opens on the high, the bar sells off, widespread, high volume. It's distribution. That's what it looks like. ACB, another weed-related stock. Look at the respect the stock has for its 21. Bounces perfectly off of it. Tightness in price, low volume, off it goes. Now, this stock goes from, what's that, about $70 to that'd be $130 up there. Lower the bar, lower the bar, lower the bar if you think it's extended. It's not too difficult. EXPI, this is like textbook chart. If you're going to print off one chart, print off this chart. So here, really good move up. Look at the respect the stock has for the 10 EMA. This is probably the best chart out of all the ones you're going to see in terms of what I was trying to get across in this video. Look how the stock moves up here. Look at the positive price action with the good volume coming through. Shake out demand tail. Look at the multiple tight candlesticks and generally speaking, the low relative volume. Multiple tight candlesticks, low relative volume is a sign that there's very little supply coming to the market. Extreme tightness in price before the stock moves up. This is the trigger bar concept in a nutshell. Stock moves up, this time pulls in, finds support around the blue line being the 21 EMA. Look at the tightness, look at the volume dry up, and then it goes. And then if you think the stock is extended, 10 EMA, 21 EMA, or lower the bar, 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 just check it off. Here as well, lower the bar, lower the bar, lower the bar, lower the bar, check it off. See how effective it is? Really effective. Let me keep going. Let me find you some more really interesting ones. This is Smartsheet, so we've been talking about a couple straight from its IPO. So see here, just starts basing, basically a Darvis box, finds support on its 10 EMA, volume dries up, off it goes. Then look at this here, really volatile. lower the bar, lower the bar, lower the bar. Like that there, it's extended from the 10 visually. It's a very volatile candlestick. Like that's distribution going on up there. CLSP, again, from its IPO, finds supportive action around its 10, basically builds a Davis box, low volume, off it goes from $5 to $16. And if you think it's extended, lower the bar, lower the bar, lower the bar, lower the bar, check it off, or let some ride. Don't have to be all or nothing decision. Let's go into, let me find some really good ones. AMD, gap down reversal bar here, underneath its 21 DMA. So remember, there's areas where I'd be expecting large operators to step up and support leading stocks. 21 EMA would be one of those areas. So gap down reversal bar, what do you think large operators were doing here? So prior closes here, gaps down, opens on the low, pushes up here, and look at the volume. Volume's not even above the 30-bar average. What does that tell you about supply? There ain't much supply. That's really good if the stock can then set up like it does here. Tight inside bar sitting on the 10. Volume dries up. Off it goes. Especially then when you can free roll it the first day as well. Like that's ideal. That's the whole point of trigger bar. Get in, free roll it, sit for the intermediate term trend, however far it may go. Tesla, we looked at that one earlier in terms of choking it off. Kodaks, these are getting into like some 2021s. Nothing's changed. This was a vaccine play. Novavax, gap up here, tightness, find support on the 21. Look at the respect for the blue line, the 21. Look how the volume dries up, and then again keeps them back. I think this is about 200% move or something like that. But then here, like these are the danger signals coming through. Even here, this gap up volatile bar. You think it's extended? Think about choking some off. Study it. Study what are the optimal settles. PRTS. This is nearly as perfect high type flag as you'll ever see. So see how the stock moves here. It goes from about $3-4 up to a high of this base of about $11, and then it doesn't close below its 10-day EMA. Bounces off of it here with this shakeout. Little gap down reversal bar, find support on its 10-day, shake out demand tail, and then look at the tightness that comes through. Look how the volume dries up, look at the 52-week highs, look at the trigger bar. So think about it from an optimal standpoint of when was the optimal time to enter it, where's the optimal place to place your stop loss in terms of creating a favorable risk versus reward trade, where's the optimal time to take some off, so then you free roll the trade, and then what are some optimal guidelines to help maximize the profit. Now, is it going to be perfect on every single trade? Absolutely not. Trading doesn't work out like that. So it's about having a toolkit to think about things. Overstock looks really, really similar to PRTS in a way. Here, tight. There it goes. Where's the danger signal? Closes below its 1021 EMA. Volume pops up. Danger signal. How'd it goes? Down it goes. Fastly. The same. APPS. Look at the respect for the 21. Tightness and price. Inside bar. Off it goes. Here again. Little inside bar. 1021 EMA. Big shakeout demand tail in the base. So gap down reverse bar, shakeout demand tails are common things you're going to see within the base. Leading stocks are trying to go higher with the fewest amount of people on board. MP, ridiculously tight bar in there. Volume dries up. That's a trigger bar. SMIT. That's a trigger bar in there. Now, yes, the bar before was also a trigger bar. The bar before that was also a trigger bar. Like, you're going to see a lot of trigger bars in a lot of different places. But it's about trying to identify the ones that I think have found support of action around their 1021 EMA. Potentially, if it's a much bigger base, maybe I'll bring the 50 SMA into that as well. Celsius, this is a ridiculously good setup, especially if it has a great reaction to the earnings and then starts basing and holding key moving averages, in particular the 10 EMA being the black line or the 21 EMA as well. Trigger bar in here, ridiculously tight bar. Through the high, stop there, sorry I bought it. Through the high there, free roll it, and then try and ride it. And if you think it gets extended, lower the bar, lower the bar, lower the bar, lower the bar. But then look at the danger signals. Look how the stock suddenly starts to act differently. Like, I think all the clues are in the chart. Like, of course, ideally you want to be trading like the leading stocks in the market, as Livermore said, leading stocks from leading groups. So there's obviously some fundamental work to be going into that, but it's about combining the fundamentals with the technical action as well. Tesla, it's just literally the same thing. GameStop, we looked at that earlier in terms of choking it off. Zom, penny stock, exactly the same thing. Tight inside bar here, volume dries up. Out it goes, you think it's extended, lower the bar, lower the bar, lower the bar. That's where I was buying it, right there. Lower the bar, lower the bar, lower the bar. Just choke it off. TAOP, so sometimes you can get a stock, powers out like that, and you think, oh, this is going to be the best trade since sliced bread, and then 5 days later you're stopped. And this is the point. You don't know whether it's going to go up 5%, 50%, 500%, or 5 days later you're stopped out, and you had potentially a really big gain on your hands, and then it rolls out and you get stopped out, and it wasn't the trade that you had envisioned. It's trading. Emotionally, you're going to have to learn to deal with it. Sky T, see how this basically builds its Davis box from its IPO. Tightness around the 10 EMA. We've seen quite a few of these now, haven't we? Again, it just repeats. Pratt, I think we maybe looked at that one earlier for choking it off. LEDS, we looked at this one earlier for choking it off. AMEH, tightness and price. Ride the trend. CAC, this is a really good one. Powers up here, good reaction after the earnings. Look at the volume coming through. Shake out demand tail underneath the 10. and look how many lows it undercuts. What do you notice about the volume? There ain't much volume. Pulls in, tightens up, right on the 10, trigger bar, out it goes. Nice. Nvidia, this is on the 1 hour chart, same concept here. Good reaction coming through. Look at the volume, look at the positive price action. 10 and 21 now on the 1 hour chart. Look at the tightness, look at the trigger bar in here. Look at the respect the stock has for its 10 and 21 on the 1 hour chart. Tightness, low volume. What does that tell you about supply? Very much supply. And then you start to see the danger signals up here. Look at this bar here, right? The signal at the top. Gap up, open on the high of the bar, closes pretty much on the low on increased volume. Look at the distribution coming through on this bar here as well. You start to see when a stock is acting right and it's being accumulated and when it's being distributed. Hopefully it's really starting to stand out. BRCC, this is a little kind of VCP flag on the 1 hour chart. Tight, tight, tight. Look at the respect for the blue line being the 21. Holds here, holds here, holds here. Look at the tightness. Look at the trigger bar coming through. Now sure, like this is a trigger bar as well. This is a trigger bar, but it didn't move through the high. This is a trigger bar as well, 2 bars later. This is a trigger bar over here. Like you're going to see trigger bars everywhere. Coca-Cola on the weekly, we've seen Coca-Cola a few times, haven't we? Look how orderly the pullback is. Look how the volume just dissipates as well. And then look at the change of character bars coming through. Let's do a couple of others. Kappa, this one here, huge move here. There was a lot of insider buying going on by the chief exec. I think the CFO and some directors were buying in here. Look how the stock then pulls back down, inside bar around the 10. Pulls back down, inside bar, sitting on the 10, and then a really good trend unfolds. And then here's the danger sign, slicing through the 21 EMA. Slicing through the 21 EMA like that on a pop in volume is a sign to me that there is a change at the intermediate term trend, that kind of point, the danger signal. Object in motion tends to stay in motion until acted upon by a superior force, and forces we're thinking about supply and demand here. PRQR, look at the tightness in price. Like, look at the tightness in price. Like, it really doesn't matter. 1970s, 2022, 2023, this will be the same thing, I think, in 2030, 2040, 2050, forever, basically. It's supply and demand. You'll see this across all time frames. If you haven't watched one of my more recent videos about trigger bars and things like that, like, you'll just see this across all the time frames. So I'm here again, kind of like a VCP, but look how it finds supportive action on the blue line, even on the 1 hour chart. It's looking for stocks that respect and move very orderly these moving averages. Like, they're just the better ones to trade. It's a sign that something, someone, somewhere is more likely supporting it. Look at the tightness coming through. You start to see the trigger bar concept. Now, yes, this bar here is a trigger bar, right? This bar here is a trigger bar through the high. So the stock here just gaps down, then it would have taken it out there. So the stop then would have been placed here, wouldn't have been stopped out, and still in here. So yes, there's then trigger bars here, there's a trigger bar here, there's potentially a trigger bar here. So just because you see a trigger bar doesn't mean, oh, right, it's going to rush up, it's going to go high, now it's going to go up 100. It didn't work like that. Like, it didn't work like that. But this is what I see happen a lot. There's slight variations with it, as Livermore said, but this is what I see happen very commonly. This extreme tightness in price setting up around one or more key moving averages before the leader really wants to come out. But that's what I'm looking for. So then I'll finish off with this slide. If you want to go and screen for some of these stocks here, this has been a pretty long video. I have my own screening software, my own screener tool on my website. At the time of filming this, there's a 7-day free trial. You don't even need to enter a credit card. So if you want to go and have a play around and go look for some of these type of stocks potentially setting up like this, then I would say go over to that, sign up. It's absolutely free to do so. Click on the stock screen hero here. You've got pre-built screens to help identify these. There's a VCP screen. There's also a high tight flag screen. So have a go, have a play around. The high tight flag screen, you can see the parameters here. You can create your own screens as well. I've got it set here for the US. You could change that to the Indian market, to the Canadian market, to the UK market, the Indian market. There's some interesting ones there as well potentially. But here, then what I would do is I would sort them on a relative strength rank, put the 3-month to the highest or the 1 week to the highest. Have a play around with that, then hit charts or hit flex charts. See what you can come up with. So that's it, guys. I'll wrap it up there. Thank you very much for watching, especially if you made it to the end. I really do appreciate the support that you guys give me on the channel. Please do like the video. If you have any comments, any questions, just let me know down below. I'll do my best to respond personally to you. Thank you very much for watching again, and I will see you in a future video.